The world's largest lithium mine sits 250 kilometers south of Perth in Western Australia, and China controls over half of it. This isn't just another mining deal. This is the story of how global battery dominance gets decided, how financial crisis reshapes ownership, and why the future of electric vehicles might depend on a small Australian town most people have never heard of. Welcome to Greenbushes, where lithium mining has been happening since 1983, where Chinese investment now holds the controlling stake, and where the battle for the electric vehicle revolution is being fought beneath red Australian dirt. Here's what makes this story absolutely critical. Australia produces 46% of the world's lithium, nearly half of global supply. The country dominates hard rock lithium mining like no other nation on Earth. And right at the center of this dominance, Greenbushes, the single largest hard rock lithium mine in the world, producing approximately 1.5 million tons of spodumene concentrate annually. But the real twist? Chinese company Tianqi Lithium controls 51% of this Australian mining giant through a joint venture structure that reveals everything about modern resource geopolitics, strategic industrial planning, and the vulnerabilities of depending on a single dominant player. Let's break down exactly how this happened, what it means for Australia, and why this story should matter to anyone watching the electric vehicle revolution unfold. The Greenbushes deposit has been producing minerals for over 130 years. Think about that. This isn't some recent discovery. This is one of the oldest continuously operated mining fields in all of Western Australia. It started with tin extraction in 1888, shifted to tantalum in the 1950s when computer capacitors created massive demand, and then the lithium era began. In the late 1970s, geologists identified a lithium ore body at Greenbushes. Commercial lithium production started in 1983, making it the world's first company to produce lithium concentrates from a hard rock facility. While everyone else was focused on brine extraction from salt flats in South America, Australia was pioneering a completely different approach, mining spodumene directly from pegmatite rock formations. This geological advantage cannot be overstated. The pegmatite deposit features exceptionally high-grade spodumene with lithium oxide concentrations that significantly exceed global averages. We're talking about ore grades of 1.9% lithium oxide in proven reserves. Those are premium numbers that make processing economically viable even when lithium prices drop. The deposit consists of two main lodes, the central lode and the Kapanga lode. The central lode displays remarkable continuity in thickness, stretching approximately 3 kilometers long and up to 300 meters wide. These aren't small deposits. This is a massive mineral resource, estimated at 440 million tons, with an average lithium oxide grade of 1.5%, equivalent to approximately 16 million tons of lithium carbonate equivalent. And here's where it gets interesting. The mine currently has proven and probable reserves of 172 million tons grading 1.9% lithium oxide, equivalent to approximately 8.1 million tons of lithium carbonate equivalent. With production rates and expansion plans, this mine has decades of operational life ahead of it. So how did China end up controlling this Australian treasure? The story involves corporate restructuring, strategic investment, financial crisis, and geopolitical maneuvering that would make a corporate thriller jealous. Greenbushes is owned and operated by Talison Lithium Australia Pty Ltd, but Talison itself is owned through a joint venture structure called Windfield Holdings, and this is where the Chinese stake comes in. Windfield Holdings is split between two parties. Tianqi Lithium Energy Australia holds 51% ownership, while American chemical giant Albemarle Corporation holds the remaining 49%. But wait, it gets more complex. Tianqi Lithium Energy Australia itself is a joint venture between China's Tianqi Lithium Corporation, which holds 51% of that entity, and Australian mining company IGO Limited, which holds 49%. Follow the ownership chain. Tianqi Lithium from China holds 51% of Tianqi Lithium Energy Australia, which holds 51% of Winfield Holdings, which owns 100% of Talison Lithium, which operates the Greenbushes mine. When calculated through this structure, Tianqi Lithium holds an indirect interest of approximately 26%, while IGO holds approximately 25% and Albemarle holds 49%. The critical detail: Tianqi Lithium holds the controlling stake at the Winfield Holdings level. 51% means control over operational decisions, strategic direction, and expansion planning. How did Tianqi acquire this position? The company purchased its stake in Greenbushes operations in 2012, then sold a minority portion to Albemarle in 2014 to form the joint venture structure. This gave Tianqi control of the world's largest hard rock lithium mine, while sharing the capital requirements and operational risks with a major American chemical company. For China, this wasn't just a mining investment, this was strategic resource security. Tianqi Lithium is the second largest lithium company in the world by revenue and the largest in China. Controlling Greenbushes meant controlling the primary feedstock for lithium processing, which China dominates globally. And here's the geopolitical dimension. China controls over 65% of global lithium refining capacity and 77% of battery production capacity. Having ownership of the world's largest hard rock lithium mine means China secures the entire supply chain, from mine to battery to electric vehicle. For Australia, this creates a complex situation. The country produces 46% of the world's lithium, an absolutely dominant position. Australia's lithium exports reached 3.35 million tons of spodumene concentrate annually, supporting the nation's 36% global market share in lithium extraction. But here's the catch: 94% of Australia's lithium exports during the first half of 2025 went to China. That's right, nearly all of Australia's lithium production flows to Chinese processing facilities. Even lithium that Australian companies mine gets shipped to China for refining because that's where the processing infrastructure exists. This creates what industry analysts call supply chain dependency. Australia controls the raw material, but China controls the value-added processing that turns spodumene concentrate into battery-grade lithium hydroxide or lithium carbonate. Greenbushes itself reflects this dynamic perfectly. The mine produces spodumene concentrate, essentially crushed and processed rock containing lithium minerals, but that concentrate must be further refined into lithium hydroxide, which is what battery manufacturers actually need. And where does that refining happen? Two nearby facilities: the Kemerton lithium hydroxide plant, owned by Albemarle, and the Kwinana lithium hydroxide plant, owned by Tianqi Lithium Energy Australia. The Kwinana facility represents Australia's first lithium hydroxide production plant and the first overseas lithium hydroxide production line operated by a Chinese enterprise. With a designed annual production capacity of 24,000 tons of battery-grade lithium hydroxide, this plant was supposed to capture more value from Australian lithium by processing it domestically rather than shipping raw concentrate overseas. But here's where the story takes a dramatic turn. Financial crisis hit Tianqi Lithium hard. The company posted a net loss of 7.9 billion yuan in 2024. That's approximately 1.1 billion US dollars. This marked Tianqi's largest loss since going public and represented a complete reversal from the 7.3 billion yuan profit the company reported in 2023. What happened? Lithium prices collapsed. After surging to historic highs in 2022, driven by electric vehicle battery demand, lithium prices plunged approximately 80% from peak levels as global supply expanded faster than demand growth. Battery-grade lithium carbonate prices fell from over 500,000 yuan per ton in late 2022 to under 100,000 yuan per ton by late 2023 and into 2024. This price crash devastated profit margins across the entire lithium industry. Tianqi's operating revenue in 2024 dropped 67.75% year-over-year to 13.063 billion yuan. The company's lithium chemical segment, which includes the Kwinana refinery, saw particularly severe margin compression. The Kwinana refinery, despite being strategically important as Australia's first lithium hydroxide plant, operates at a significant financial loss. Rising operational costs, including energy, reagents, and labor, combined with collapsing lithium prices, made the economics brutal. The facility processes spodumene concentrate from Greenbushes, but the value of the output wasn't sufficient to cover processing costs. In January 2025, Tianqi made a stunning announcement. The company would halt construction of the second line at the Kwinana refinery. The second line, which had a planned lithium hydroxide capacity of 24,000 tons per year and had already received preliminary investment of 1.4 billion yuan, was deemed not economically viable given market conditions. This decision resulted in an impairment provision of approximately 1.412 billion yuan for construction in progress and right-of-use assets. The company was literally writing off the value of partially completed construction rather than throwing more money into an unprofitable venture. Think about the implications. China's largest lithium company, which controls the world's largest lithium mine, couldn't make the economics work for lithium processing in Australia. Despite having guaranteed access to feedstock from Greenbushes, despite Australian government support for domestic processing, despite strategic ambitions to control the entire supply chain, the numbers didn't add up. But Tianqi's troubles extended beyond Kwinana. The company's investment in Chilean lithium producer SQM also contributed to the massive losses. SQM reported a full-year loss of $404 million, which flowed through to Tianqi's income statement because the Chinese company holds a 20% stake in the Chilean producer. Tianqi had borrowed heavily to acquire that SQM stake, taking on billions in debt just as lithium prices peaked. When prices collapsed, the company found itself caught with massive debt obligations and plummeting revenue. In March 2020, engineering contractor MSP Engineering took Tianqi Lithium Kwinana to the Supreme Court of Western Australia with a lawsuit claiming unpaid invoices of 35.9 million Australian dollars. Facing this liquidity crisis, Tianqi had to restructure. In December 2020, the company sold a 49% interest in Tianqi Lithium Energy Australia to Australian nickel gold miner IGO Limited in a $1.4 billion deal. This transaction brought much-needed capital while allowing Tianqi to retain control through its 51% stake in the restructured entity. For Australia, this created an interesting development. An Australian company, IGO, now held an indirect stake in Greenbushes alongside the Chinese and American joint venture partners. Some analysts saw this as reducing foreign control, though Tianqi still maintained the controlling position. Now, what does all this mean for Greenbushes itself? Despite the financial troubles of its owner, the mine keeps producing. In 2024, Talison produced 1.41 million tons of lithium concentrate. That's remarkable operational performance, even as lithium prices cratered. The mine currently operates 4 lithium concentrate beneficiation plants with total capacity of approximately 1.62 million tons per year. A third chemical-grade processing plant is under construction and expected to come online in October 2025, which will increase annual capacity to approximately 2.14 million tons. Greenbushes produces two types of concentrate: chemical-grade lithium concentrate, which is what battery manufacturers need, and technical-grade lithium concentrate, which goes into ceramics, glass, and other industrial applications. This diversification provides some market protection when battery demand fluctuates. The mine's expansion reflects long-term confidence despite short-term price volatility. The existing pits, designated C1, C2, and C3, are being combined and expanded as a single open pit, approximately 2.8 kilometers long, 1 kilometer wide, and up to 450 meters deep. The mining rate is increasing to approximately 16 million bank cubic meters annually to support the higher production targets. And there's more. The mine has an estimated 40-year project life based on current reserves and production rates. Even with aggressive expansion plans, Greenbushes has decades of lithium supply ready to meet global battery demand. So let's address the big question: is China taking over Australian lithium? The answer is nuanced. Chinese companies hold significant ownership stakes in several Australian lithium projects. Beyond Greenbushes, Ganfeng Lithium holds a stake in Pilbara Minerals, another major Western Australian lithium producer. Chinese investment flows into Australian lithium exploration and development through partnerships, offtake agreements, and equity stakes. But takeover suggests total control, and that's not quite accurate. Australian companies like IGO, Pilbara Minerals, Mineral Resources, and Liontown Resources remain significant players. American companies like Albemarle maintain major stakes. The ownership is genuinely multinational, even if Chinese interests hold controlling positions in some cases. What is happening is strategic positioning. China has systematically invested in securing lithium supply at the source, the mine level, while simultaneously dominating the downstream processing and battery manufacturing. This vertical integration means China captures value at every stage of the supply chain. Consider the numbers. China accounts for approximately 2/3 of global refined lithium supply. That's processing dominance. When Australian mines produce spodumene concentrate, where does it go? Predominantly to Chinese refineries. During the first half of 2025, China absorbed 94% of Australian lithium exports, 1.86 million tons out of 1.98 million tons total, shipped. This creates what some analysts call dependence asymmetry. Australia depends on China to buy its lithium concentrate, while China depends on Australia to supply the raw material. Both sides need each other, but China has diversified its sources by investing in lithium projects in Chile, Argentina, Zimbabwe, and the Democratic Republic of Congo, while Australia remains heavily reliant on the Chinese market. For Australia, this situation presents both opportunities and vulnerabilities. The opportunities are substantial. Lithium exports generated $5.2 billion in fiscal year 2025 and are forecast to reach $8.2 billion by fiscal year 2030. That's significant economic contribution from a single commodity. Australia's lithium exploration expenditure increased from just $1.4 million in 2015 to $298 million in 2024, representing 27% of global lithium exploration investment. But the vulnerabilities are real. What happens if China develops alternative lithium sources? What happens if China slows electric vehicle production? What happens if geopolitical tensions disrupt trade relationships? Australia's heavy dependence on Chinese processing and markets creates exposure to decisions made in Beijing. Some Australian policymakers recognize this. There's been increasing interest in building domestic lithium processing and battery manufacturing capabilities. The Kemerton refinery, operated by Albemarle, and the Kwinana refinery, operated by Tianqi IGO, represent attempts to capture more value domestically rather than simply exporting raw concentrate. But as Tianqi's financial troubles demonstrate, building profitable domestic processing isn't easy. Chinese refineries benefit from scale, established infrastructure, government support, and proximity to battery manufacturers. Replicating that ecosystem in Australia requires massive capital investment and guaranteed offtake agreements. The federal government has tried to help. In 2024, Australia extended a $230 million Australian dollar loan to Liontown Resources for its Kathleen Valley lithium mine, which began production in July 2024 with expected annual output of 500,000 tons of spodumene concentrate. Government support aims to ensure Australian lithium mines remain competitive even during price downturns. But government loans don't solve the fundamental question: should Australia be content as a raw material supplier, or should the nation invest aggressively in moving up the value chain into processing and manufacturing? The Greenbushes story reveals the complexity of this decision. The mine itself is world-class: exceptional geology, proven reserves, established infrastructure, experienced workforce, reliable production. It generates employment in regional Western Australia, export revenue for the nation, and critical supply for global battery markets. Yet the majority of the value gets captured elsewhere, in Chinese refineries that turn concentrate into hydroxide, in Chinese factories that turn hydroxide into battery cells, in Chinese assembly plants that turn battery cells into electric vehicles. Some analysts argue Australia should accept this division of labor. Mining is what Australia does exceptionally well. The country has regulatory stability, geological expertise, established supply chains, and competitive mining costs. Why compete with China in processing and manufacturing where China has overwhelming advantages? Other analysts argue Australia must develop domestic processing capabilities to ensure supply chain resilience and capture more economic value. What happens if trade routes get disrupted? What happens if export restrictions get imposed? Having domestic processing capacity provides strategic security, even if it's not immediately profitable. The reality? Both perspectives have merit, and Australia is pursuing a mixed approach, maintaining dominance in mining while selectively investing in processing projects that can achieve competitive economics. Let's talk about what's happening right now at Greenbushes and across Australian lithium. Despite Tianqi's financial troubles and the halted expansion at Kwinana, Greenbushes continues expanding mine production. The third chemical-grade processing plant is under construction with an expected completion in 2025, adding 520,000 tons per year of concentrate production capacity. But the mine has also faced some challenges beyond commodity prices. In April 2025, Talison Lithium requested permission to expand the mine's footprint by 619 hectares, almost one-third larger than the current size, to accommodate waste disposal and build the new processing plant. This provoked significant reaction from the local community of Greenbushes. Residents complained about dust affecting homes, schools, and agriculture. One resident described children's play equipment covered in constant dust, orange trees coated in white layers, sticky, dry eyes, skin conditions, and coughing. The Western Australia Environmental Authority responded to 364 public comments, 95% of which demanded action, by agreeing to conduct a full environmental assessment of the expansion plans. This review is scheduled for 2026 and will examine dust control, noise management, water usage, visual impacts, and ecological effects. Company CEO Rob Telford publicly acknowledged the impacts. "We deeply regret the impacts felt by members of the Greenbushes community. I have made it a priority to personally meet face-to-face with some of our most affected residents to hear firsthand about their experiences. This community pushback reveals an important dimension of resource extraction. Mines don't operate in isolation. They affect real people, real communities, real environments. Balancing economic benefits against local impacts requires genuine engagement, effective mitigation measures, and regulatory oversight. The Greenbushes expansion review will test whether mining companies, communities, and regulators can find sustainable approaches that allow resource development while protecting community well-being and environmental quality. Meanwhile, across Australian lithium more broadly, market conditions remain challenging. Several lithium mines have temporarily closed or scaled back operations due to low prices. Core Lithium and Sayona Mining paused production to preserve capital when prices fell below their operating costs. Even world-class operations like Mount Cattlin face difficulties. In September 2024, the mine's owner, Tianqi Lithium, announced plans to suspend expansion investment and place the mine into care and maintenance by the end of the first half of 2025. When lithium prices are low, even high-quality deposits can become uneconomical to operate. But here's the fascinating paradox. While some mines close, others keep expanding. Pilbara Minerals plans to boost lithium ore production at its Pilgangoora operation by 50% through its P1000 project. How can both things be true simultaneously? The answer lies in cost structures and strategic positioning. The lowest-cost producers like Greenbushes, Pilgangoora, and Mount Marion can remain profitable even at depressed prices. These operations have exceptional geology, established infrastructure, economies of scale, and efficient processing that keeps costs competitive. Higher-cost marginal producers get squeezed out during price downturns. When lithium carbonate sells for 95,000 yuan per ton instead of 500,000 yuan per ton, only the most efficient operations survive. This industry consolidation actually strengthens the survivors by reducing global supply and potentially supporting price recovery. And price recovery might be coming. Industry analysts expect lithium demand to grow at approximately 13% annually through 2030, driven by electric vehicle adoption and battery energy storage systems. Global EV sales rose 26% to over 17 million units in 2024, with China leading the charge. By 2040, the International Energy Agency expects lithium demand to be more than 40 times current levels if the world meets Paris Agreement climate goals. That's not incremental growth, that's exponential transformation. Even if we don't hit those aggressive targets, lithium demand is clearly trending upward long-term. The current oversupply situation is expected to diminish over the next 5 years as demand growth catches up with expanded supply. When that rebalancing occurs, prices should recover, maybe not to the extreme highs of 2022, but to levels that make quality operations profitable. For Greenbushes, this means the mine's long-term value proposition remains strong despite short-term volatility. The reserve base of 172 million tons, grading at 1.9% lithium oxide, provides decades of supply for future battery demand. The operational capability to produce over 2 million tons of concentrate annually positions Greenbushes as a critical supplier regardless of who holds the ownership stakes. And that raises a philosophical question. Does it matter who owns the mine if the lithium keeps flowing to global markets? From an economic perspective, ownership determines who captures profits, who makes strategic decisions, and who benefits when commodity prices recover. Chinese control of Greenbushes means profits flow to Chinese shareholders when times are good. Chinese executives make expansion decisions, and Chinese strategic planning drives operational priorities. From a geopolitical perspective, ownership creates potential vulnerabilities. Could Chinese-controlled Australian lithium mines favor Chinese buyers during supply shortages? Could production decisions get influenced by political considerations beyond pure economics? Could trade disputes lead to export restrictions? These aren't hypothetical concerns, they reflect real tensions in the US-China-Australia triangle. The United States views lithium as a critical mineral essential for economic and national security. China views lithium as crucial for industrial leadership and energy transition. Australia views lithium as an economic opportunity, but recognizes the geopolitical dimensions. Australia has mechanisms to review and potentially block foreign investment through the Foreign Investment Review Board. The sale of Tianqi's stake to IGO required FIRB approval, specifically because it involved foreign ownership of critical resources. The government can impose conditions on approvals or reject deals that threaten national interest. But Australia also benefits from Chinese investment. Capital flows from Chinese companies have funded lithium mine development, created employment in regional areas, generated export revenue, and integrated Australian operations into global supply chains. Completely blocking Chinese investment would reduce Australia's ability to develop its mineral resources. The pragmatic approach? Managed engagement, allowing Chinese investment while maintaining regulatory oversight, ensuring Australian companies remain significant players, building domestic processing capabilities where economically viable, and diversifying export markets to reduce dependence on any single buyer. Some progress is happening on that diversification front. Indonesia emerged as the second largest importer of Australian lithium in the first half of 2025, increasing purchases by 165% year over year to reach 66,678 tons. Indonesia is aggressively developing battery materials processing as part of its industrial strategy. South Korea reduced Australian lithium imports by 33% year over year, down to approximately 45,000 tons, as Korean battery manufacturers invested in their own direct lithium processing capabilities. Japan maintains stable imports at around 15,000 tons. The United States accounts for roughly 10,000 tons, with growing momentum as domestic battery production expands. These markets remain tiny compared to China's dominance. 94% market share is overwhelming. But the trend toward diversification creates optionality for Australian producers and reduces the risk of overdependence on Chinese demand. Let's zoom out and consider the bigger picture. The Greenbushes story encapsulates the fundamental challenge of the energy transition. The world needs massive amounts of critical minerals to build batteries, solar panels, wind turbines, and electric vehicles. Those minerals are concentrated in specific geographies. The companies with capital, technical expertise, and strategic vision to develop those resources will shape the 21st century economy. China recognized this early and invested accordingly. While Western companies focused on oil and gas, Chinese firms invested in lithium, cobalt, rare earths, and other battery materials. By the time Western policymakers realized critical minerals mattered, China had already secured controlling positions across global supply chains. Australia holds enviable geological endowments, world-class lithium deposits, massive iron ore reserves, significant copper and nickel resources, rare earth elements, and more. The question is how Australia leverages these advantages. Does the nation maximize short-term economic returns by selling raw materials to whoever pays the most? Or does Australia make long-term strategic investments in processing and manufacturing to capture more value and ensure supply chain participation? There's no simple answer because the economics and geopolitics pull in different directions. The The most economically efficient outcome might be specialization. Australia mines, China processes, everyone benefits from trade. But the geopolitically secure outcome requires redundancy and resilience, multiple countries capable of performing each step, reducing dependence on any single player. The Greenbushes mine itself will continue operating regardless of these philosophical debates. The geology is too good, the reserves are too large, the operational expertise is too established. Whether owned by Chinese companies, American companies, Australian companies, or some combination, Greenbushes will keep producing lithium as long as global battery demand exists. But the ownership structure matters for how profits get distributed, how decisions get made, and how vulnerable Australia is to external pressures. That's why the Tianqi Albemarle IGO joint venture structure is actually somewhat reassuring. It spreads control across Chinese, American, and Australian interests, making unilateral decisions difficult. Could this balance shift? Absolutely. If Tianqi's financial troubles worsen, the company might sell more of its stake. If lithium prices recover strongly, Tianqi might buy out partners. If geopolitical tensions escalate, governments might force restructuring. The current ownership configuration isn't permanent. It's a snapshot of competitive and strategic dynamics at this moment. What about the workers at Greenbushes? What about the town? What about regional Western Australia? The mine employs hundreds of workers directly and supports thousands of jobs indirectly through contractors, suppliers, and service providers. Towns like Greenbushes, Bridgetown, and Bunbury benefit from mining-related economic activity. When the mine prospers, the region prospers. But there are legitimate concerns. The environmental impacts we discussed, dust, noise, heavy haulage, expanding footprints, affect local quality of life. The boom and bust cycles of commodity markets create economic instability. When lithium prices soar, everyone benefits. When prices crash, contractors lose work, service businesses struggle, and uncertainty dominates. Some community members feel decisions about their region get made in distant boardrooms, in Charlotte, where Albemarle is headquartered, in Perth, where IGO operates, in Chengdu, where Tianqi is based. The Environmental Protection Authority review represents an opportunity for local voices to be heard and local concerns to shape development decisions. One thing is certain, the global energy transition is happening. Electric vehicle sales are growing, battery energy storage is expanding, renewable energy deployment is accelerating, and all of this requires lithium. Greenbushes sits at the nexus of this transformation. The mine produces the raw material that becomes batteries that power vehicles that reduce carbon emissions. Whether you view this as environmental progress, industrial evolution, or economic opportunity, the significance is undeniable. Australia's role as the world's dominant lithium producer isn't guaranteed forever. Other countries are developing lithium resources. Zimbabwe's production increased from 14,900 tons in 2023 to 22,000 tons in 2024. Chinese companies are investing heavily in African lithium. North American lithium projects are advancing. South American brine operations are expanding. But Greenbushes has advantages that are hard to replicate. Exceptional geology discovered decades ago, developed infrastructure built over generations, operational knowledge refined through continuous production, proven reserves measured in hundreds of millions of tons, and strategic location near established export facilities. These advantages don't disappear because of ownership changes or price volatility. They remain inherent characteristics of the deposit itself. That's why Greenbushes will continue as a pillar of global lithium supply, regardless of who holds the corporate ownership. So, is China taking over Australian lithium? The accurate answer is China has secured controlling stakes in some Australian lithium operations, including the world's largest hard rock lithium mine, as part of a deliberate strategy to control battery supply chains. This represents significant Chinese influence, but not total takeover, as Australian and American interests remain substantial players. The real question isn't whether Chinese investment exists. It clearly does. The real question is whether this arrangement serves Australia's national interests. Does it provide capital for resource development? Yes. Does it create employment and export revenue? Yes. Does it position Australia strategically in the energy transition? Partially. Does it create dependencies and vulnerabilities? Also yes. Managing these trade-offs requires sophisticated policy, effective regulation, and strategic thinking about Australia's role in global supply chains. Simply blocking foreign investment reduces development capital. Simply allowing unrestrained foreign ownership creates vulnerability. The challenge is finding the middle path. For Greenbushes specifically, the current ownership structure, Chinese control through Tianqi, American participation through Albemarle, Australian participation through IGO, provides some balance. No single party can make unilateral decisions. Expansion plans require joint venture agreement. Offtake arrangements must consider all partners' interests. Is this optimal? Maybe not. But it's workable, and it keeps the mine operating productively while global lithium markets navigate this volatile transition period. Looking forward, several factors will shape the future. Lithium prices will eventually stabilize at sustainable levels that support marginal cost production. This might mean prices around $1,200 to $1,500 per ton of spodumene concentrate, well below the crazy highs of 2022, but sufficient to keep quality operations profitable. Electric vehicle adoption will continue growing, though the pace remains uncertain. China will remain the largest EV market, but Europe and North America are expanding. Battery chemistry innovation might reduce lithium requirements per vehicle, but growing EV volumes should offset this. Processing capacity will increasingly shift closer to raw material sources. As Tianqi's Kwinana struggles demonstrate, building profitable refineries outside China faces challenges. But some projects will succeed, especially those with government support, scale advantages, or unique technologies. Geopolitical tensions around critical minerals will intensify. The United States, European Union, Japan, and other advanced economies recognize their vulnerability in battery supply chains. Expect more policies promoting domestic processing, more investments in alternative suppliers, more diplomatic efforts to secure resources. For Australia, the opportunity is clear. Maintain dominance in lithium mining while selectively developing processing capabilities where economics allow. Continue attracting foreign investment while ensuring strategic resources serve national interests. Build diverse export relationships while recognizing China's central role in battery manufacturing. And for Greenbushes, the mine will keep producing, engineers will keep blasting rock, processors will keep concentrating spodumene, trucks will keep hauling concentrate to Bunbury for export. The lithium will keep flowing to global markets. Whether owned by Chinese companies, American companies, Australian companies, or some combination, whether exporting to China, Indonesia, Korea, or elsewhere, whether processing continues at Kwinana or concentrates ship overseas, Greenbushes remains fundamental to global lithium supply. The ownership questions matter for profits, control, and strategy, but the geological reality matters most. Greenbushes holds world-class lithium resources that global battery markets desperately need. That underlying value proposition transcends ownership debates. So when people ask, is China taking over Australian lithium? The honest answer is nuanced. Chinese companies have strategically invested in controlling stakes across Australian lithium operations as part of systematic supply chain integration. This reflects China's industrial planning excellence and provides Australia with development capital, but it also creates dependencies that require careful management. Australia must balance economic pragmatism with strategic autonomy, welcoming investment while ensuring ultimate control of critical resources. China must balance resource security with international relationships, securing supply without triggering backlash. And the global community must build resilient supply chains that don't depend excessively on any single country. The Greenbushes story illustrates all these tensions perfectly. A 130-year-old Australian mining field, now the world's largest lithium operation, controlled through a complex joint venture between Chinese, American, and Australian interests, producing material that flows predominantly to China for processing, supporting a battery industry critical to climate goals. It's complicated, it's evolving, and it's absolutely crucial to understanding how the 21st century economy actually works. The lithium revolution is happening right now, in the pegmatite rocks of Western Australia, in the refineries of China, in the battery factories supplying global automakers, in the electric vehicles transforming transportation. And at the center of it all, a small town called Greenbushes, where explosives crack ancient rock, where heavy machinery extracts ore, where processing plants separate minerals, and where the future of energy transition gets dug from the earth 1 ton at a time. That's the real story of China and Australian lithium, not simple takeover, but complex interdependence, not domination, but strategic positioning, not permanent configuration, but evolving arrangements responding to markets, technologies, and geopolitics. Understanding this complexity matters because simplistic narratives miss the nuance. Yes, Chinese investment is significant. Yes, strategic concerns are real. But so are economic opportunities, technological developments, and the fundamental need for critical minerals to power the global energy transition. The Greenbushes mine will continue producing world-class lithium. The ownership structure will continue evolving. Global demand will continue growing, and Australia will continue navigating the complex balance between resource development and strategic autonomy. That's the Greenbushes story, a microcosm of resource geopolitics, industrial strategy, and the energy transition, all playing out in a small corner of Western Australia with implications that echo across the globe.